Don Straszheim. He's Senior Managing Director at ISI Group. He joins us from Hong Kong. So, Don, if I could just start out by asking you about Europe, and particularly about France. We've seen these rumors in the markets over its banks being in trouble, over perhaps it not being able to sustain this program that it's got in place to cut its deficit because growth is so slow. How dangerous do you think it is that we've seen that kind of contagion spread to France?
Well, Lindsay, all the world is now focused on Europe, I think, understandably. And as you point out, the contagion is continuing to spread. And none of the countries from France all the way down to Greece have any real good options because it's all about austerity in the presence of kind of unsustainable debt obligations. And this is, I think, precisely why you're getting so much volatility in the markets, volatility that I think is going to be with us, for some time.
That's a scary thought. So what is the answer for Europe? I mean, is it going to be more fiscal consolidation, European bonds, or are we going to perhaps see countries default?
I don't think we're going to see any defaults. I think what we will see, though, is, as you term it, more consolidation. All of these countries have the same nature. The nature of the problems are the same in all these countries. The details are a little bit different, but they require painful choices that democracies are just simply not very good at making, which is to try to pare back kind of entitlement payments programs that the public, in good faith, has expected the government is going to deliver to them. And the governments are finding that it's easier to make kind of rosy assumptions on their growth, make rosy assumptions on better tax compliance and the like, and then when they don't materialize, you get these spasms, these episodes of really big doubt.
So if this crisis, if this recession means an end to the social welfare state as we know it in Europe, it's also going to hit the U.S. because the U.S. has to cut back on entitlements as well. We've seen that debt fight going on there. How much has that argument in the U.S., the politicians failing to really get something concrete, something that investors believe in, how much has that been affecting the markets, and how much of a worry is it?
Well, I think you're right in pointing out that the kind of problems in Europe are now infecting America. And the positive thing I think about America is that at least we are addressing these problems. Now, the solutions that were supposedly come to a few weeks ago in America with the so-called debt crisis and the attendant downgrading, we didn't get very far, but we are at least talking about those problems. I think that's the first step to a solution, is recognizing that the problem exists. It's just going to take years and years of kind of pecking away at the problem before we reach any kind of final resolution.
Let's start out with this volatility, which you've predicted is going to continue for some time. What is the reason for that, the main reason? Is it visibility? Are investors just uncertain about where global leadership is taking us?
Lindsay, I think it's spasms of doubt and spasms of debt. When I got off the plane in Hong Kong this morning, I picked up the newspaper and I saw a headline that said "Addicted to Debt." And quite frankly, I didn't know whether the story was going to be about Europe, America, or about China. And there is a real question, I think, of leadership, in economic leadership all over the world right now, along with this debt and the G2 countries, America and China, having big but different problems. I think this just breeds this kind of mentality that we've seen. But this too will pass.
This too will pass when? And also, do you see a decoupling happening in terms of, at the moment, it's been a very broad-based sell-off. It's been a global phenomenon. But do you think that perhaps we might see investors dipping back into emerging markets where the growth is and perhaps staying away from the developed world for a while?
I think the emerging markets are going to do very nicely over the next 6 months, led probably by China. America, Europe, and Japan all seem to be committed to zero interest rates in a very low growth environment. Those zero interest rate policies are likely to lead to somewhat higher inflation in the emerging markets, with quite rapid growth still in those markets. That ought to give them better equities there.
Very quickly, because we're almost out of time, what about investing in European or U.S. equities? You still have many analysts saying that you're still going to see quite a bit of upside now on the S&P between now and the end of the year.
I think those markets, too, for good investors who are looking for companies that can work their way through this weakness, will do very nicely. It's going to be a stock picker's market, though, I think, especially in the developed world.
Not for the faint-hearted. Okay, Don Straszheim, their Senior Managing Director and Head of China Research at ISI Group. Thank you for being with us.